Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to save you some money. My job is not just to entertain you, but to educate, to do some teaching. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Look, we knew it had gotten harder since November began, right? But this hard? Wow. We have reversals like this. The kind of reversal that makes you feel like you just can't take it anymore. I suggest you simply sit on your hands and hold on. It's not a sin to do nothing. Sometimes, as I make clear in How to Make Money in Any Market, it is the best course of action. This is one of those times. If you can't take the pain, and it was in abundance because the Dow opened up 428 points, S&P opened 1.4%, NASDAQ opened up almost 2.2%, only to roll over with the Dow finishing down 387 points, S&P down 1.56%, and the NASDAQ off 2.16%. We'll talk about a swing. Well, then you can still raise some cash if you don't have any by selling some losers, not winners, in order to buy the winners on the way down. That's an acceptable course of action. Today's market's instructive. It's a reminder that while your companies may be doing extremely well, their stocks, they can separate. It could be another story. Case in point, the biggest stock in the world, Nvidia. Last night, Nvidia reported one of the best quarters I have ever seen. Ahead of the report, there was tremendous angst that somehow they would blow it. They'd print a subpar set of numbers, and the stock would blow up. Instead, what happened? Nvidia reported an astonishing sales number, earnings number, gross margin number, customers, fantastic. And what happened? The stock blew up anyway. But not before it soared higher both last night and this morning. Nvidia stock opened at 195. That was up about 8 from yesterday, but then closed at 180. A hideous swing that obliterated those who bought the opening, and a lot of people did. The volume was high. Why do I keep stressing this huge intraday swing stuff? Okay, let's get technical for a second. When you get that pattern, it's a huge up opening and then the whole market craters, including your stock, professionals associate that with a very nasty moment. If your company can deliver the best quarter possible and your stock finishes the session down anyway, well, you can expect more pain. Why not? Because if it can't rally on the greatest news possible, what else can make it move back up? Sure, it might not play out that way this time, but pattern recognition matters. And right now, the pattern is terrible. I don't sugarcoat this stuff. And I say that, no, not changing my stance. I think you need to own Nvidia, not trade it. But I understand the pain. There's been so much pain since it was at 2. Let me tell you what you're supposed to do when you see this kind of pattern. You have to do a check down, just like a quarterback in the NFL looking at his receivers. First, you ask, did you miss anything with Nvidia that makes this quarter look a lot worse than it did at first glance? I read the conference call once, spoke to the company, read the conference call again, went to dinner with friends, and then read the call a third time with some analyst notes. I'm confident I missed nothing. Demand for the chips is extraordinary. Gross margin stupendous. Their customers, unlike what's constantly being said by the nattering nabobs of negativity, can't get enough of Nvidia's chips, and they're making a lot of money with them. The customers, I'm going to repeat that, are making excellent money with these chips, including some use cases where Meta, as Jensen Huang, the CEO, was explaining, demonstrable earnings gains. Second, you have to ask if there was anything in the cohort away from Nvidia that could explain the weakness of Nvidia. You have to survey the landscape to see what would explain the weakness. For that, what I like to do is look at all the intraday charts of various stocks overlaid upon the stock of Nvidia. Here's what I found. A profound, pronounced set of declines in the most elemental of tech stocks, the basic semiconductors, which have been rallying like crazy for weeks. Micron, SanDisk, Western Digital, these are storage plays, all computer companies that have been going parabolic for months now. They, not Nvidia, had become the momentum plays. Earlier this week, a Morgan Stanley analyst used the dreaded term super cycle, which almost invariably leads to a top when you hear it. As was the case with the last 2 super cycles that were called the fracking sand super cycle and the coal super cycle. Both turned out to be long-term tops, heights that were never, ever seen again, and then a crash. Sure enough, these storage stocks have been cratering for the last few days, almost on cue with the ill-fated, ill-advised super cycle call. These storage players like fracking sand and coal are commodities. Right now, they're in shortage mode because they can't make enough storage to meet the demand. I'm sure we'll discover that the shortage was just alleviated somehow. We don't know. Perhaps by some semiconductor capital equipment surge, and the prices have started to moving back to equilibrium. Equilibrium means lower prices. What else? Again, sticking with the concern that the biggest capitalization stock in the universe might be behind today's reversal, I noticed that one of the most closely correlated situations to Nvidia's trading, of all things, is crypto, especially Bitcoin. There are a host of incredibly speculative ways to bet on Bitcoin, borrow money, ways that could be catastrophic on a breakdown for some Bitcoin vehicles that will bleed into Nvidia because there's a lot of shareholder overlap. Sure enough, there's Strategy, formerly MicroStrategy, an agglomeration of crypto that public documents indicate owns about 3% of all Bitcoin, a huge holding, and finances that investment with more than $8 billion in debt. That's an insane amount of risk. JP Morgan this morning talked about how Strategy may get booted from some indices because it's basically just a scheme to own Bitcoin, not a real operating company. The piece didn't suggest it would happen soon, maybe by the middle of January. But man, there's a lot of money in index funds, and the indices include Strategy. The pressure on Strategy from these automatic sellers could be disastrous. You kick something out of the index like that, then the index money automatically departs. One more reason why you cannot afford to own that stock, and I've been saying that and saying that. It's not just Strategy. There's so many Bitcoin companies out there, and they all trade with a commodity, which broke down below the critical 90,000 level like a machete through butter. I am watching this Bitcoin Immersion Technologies, a company involved in Bitcoin hosting and mining. It was down 10.83% today.
The house of
Don't buy. Now, everyone seems to be holding on for dear life, and you know what happens when you do that. Bitcoin can lead tech down, and it's that correlated because of the leveraged state of the players involved. They're your nemesis. When Bitcoin collapses, the people who bought it with borrowed money need to sell their holdings in order to raise money, and that often includes stocks like Nvidia. That and the 2x and 3x Nvidia junk playing havoc with Nvidia stock. It's not the company itself. Fifth, you have to ask if there's anything totally away from Nvidia and tech that could be hurting things. The answer is pretty simple. The economy may be showing too much life. It looks like too many jobs are being created. The employment numbers are still pretty hopeless in terms of their veracity. But we got a string of strong numbers this morning, and some people are saying that means no rate cuts this year. Lots of stocks need rate cuts. The main ones are the most speculative ones: quantum computing stocks, alternative energy stocks, critical mining stocks, long-shot nuclear stocks, extremely levered data center stocks without any earnings, Bitcoin derivatives. They're all down big. I've made it very clear to you that until we get a washout in these stocks, until they return to earth, it will be very hard for anything to stabilize, particularly that group. And they are mostly certainly returning to earth. It won't be in a straight line, and there'll be plenty of opportunities still to get out when the defenders make the rounds on TV, which they always do. But I think that's all she wrote for the hyper-speculative groups. As I've said to you over and over and over again, the year of magical investing is over. So where do I come out? I think you have to wait for a day before you make any decisions to buy. Even after the shelling, we are still not oversold. But you should identify what you like tonight, as we are doing for the Charitable Trust, and be ready for tomorrow, because we will definitely see bargains developing. I see that the recession stocks like consumer packaged good plays are getting some love. However, I like to buy them when they're hated, not loved. And the Magnificent Seven don't look all that magnificent, at least when it comes to their stocks. That smells like opportunity to me. Bottom line, I want to see what holds tomorrow. Stocks that have come down too far, too fast, where the expectations are too low and the opportunity is too great, those are the ones I'm looking to buy on weakness, especially the high-quality techs that are now being thrown away with the Bitcoin bathwater. Scott in South Carolina. Scott!
Jimmy Chill, booyah.
Man, what's shaking with you, partner?
Hey, man, I need your wisdom cap on, big guy. Hey, I bought a stock back in late July when it went under 700. Thought it was a great deal. It ran up into earnings. It's always beat on earnings until this last time in early October, I believe. You had the president on a week or two ago. He explained that he didn't explain the EPS miss, but he explained that they made their 30%, I guess, sales that they were looking for. But my stock, I'm very convicted on this stock. I've been buying it as it's going down. I want to know, should I keep on buying Axon?
Okay, so Rick Smith was on. He comported himself as usual excellently. But remember, Motorola is in this business now, and Motorola is a powerful competitor, and they could be a trouble down the line. They weren't, according to Rick now, but I think when you have a big dog that comes in and wants that business, they can afford to give some of the business away. That's what's changed the complexion of the stock. And that's what makes me less convinced, but not convicted because I didn't do anything. All right, We need to see what stocks hold their ground tomorrow, because those are the ones that I'm looking to buy on weakness. Let's see what bounces. That's going to tell us. Well, Mad Money tonight, while we're all focused on Nvidia earnings, it has been a big week for retail. I'm running through the important reports and sharing what I think of the cohort. Then Walmart reported this morning it shot the lights out. But should investors wait for a pullback before pulling the trigger? I'll give you my take. And Gap reported after the bell. I'm talking to the CEO fresh off the company's earnings call to discuss the numbers. Stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Now that we're over the nasty hump of Nvidia, we can go back to focusing on what this week was really all about to begin with: retail. Yep, this week marks the beginning of retail earnings season. So far, let's call it a mixed bag. But given the widespread worries about the state of the consumer, I'd argue a mixed bag is actually pretty darn encouraging. This morning, we got a very good quarter from Walmart. But I want to tackle that separately because Walmart's in a class of its own. Other than Costco and the retail side of Amazon, nobody else comes close except for TJX. I'm going to circle back to get that one after the break. For now, let's talk about the major retailers that reported earlier this week. On Tuesday, we kicked things off with Home Depot, and that was an inauspicious start. The Despot posted a tiny sales beat, but both its earnings and the same-store sales came in softer than expected, and the stock plunged 6% in response. Ouch. Worse, Home Depot cut its full-year forecast for both comparable sales growth and earnings. There's a tough set of numbers. No ways around it. As management said that the uptick in demand they were expecting simply didn't materialize. Some of that's from ongoing pressure in the housing sector as rates remain elevated. Some of it's consumer uncertainty. Some of it's simply because we had a moderate hurricane season, which is great for anyone who lives near the coast, but awful for Home Depot's earnings because they don't get much rebuilding business. I also wonder if ICE's high-profile roundups of presumably undocumented immigrants at Home Depot parking lots might be playing a role, too. I didn't factor that in well enough, perhaps. Still, there's a reason we own it for the Charitable Trust, and the Charitable Trust even bought some more as the stock approached its 52-week low on Tuesday. As I see it, there's a very simple reason to own Home Depot. This company's a major beneficiary from lower interest rates, and rates are coming down. But it would help if we get the rate cut sooner rather than later. If the Fed doesn't cut at next month's meeting, this stock's going to struggle. I think you saw some of that, too. Now, the other big home improvement chain, Lowe's, reported yesterday. They did comparatively better. This company posted a modest top and bottom line beat, even if their same-store sales came in a tad light. Big difference from Home Depot. Lowe's has raised its full-year sales forecast, although they lowered their same-store sales outlook, and they adjusted the earnings guidance down a bit. I like that they had very little inventory. Inventory's down. Still, management told us that November's off to a good start with positive same-store sales so far this month. Again, good despite the lack of hurricanes. And that's why the stock rallied about 4% yesterday, although given that Lowe's sold off 2% the day before in response to Home Depot, it's still impressive. Now, CEO Marvin Ellison had a nuanced take on the consumer. He said that homeowners are healthy and their balance sheets are strong, but they're still concerned about things like the impact of the shutdown or the tariffs. So they're hesitant to make larger purchases or take on big remodeling projects. But despite this tricky environment, Lowe's is doing pretty well. Next up, Target. Oh, Jesus, tough one. Target also reported yesterday, and this ailing big box retailer delivered yet another dispiriting set of numbers. We're talking about a slight revenue miss, a nasty 2.7% decline in same-store sales, and a modest 7-cent earnings beat off a $1.71 basis. On top of that, Target slashed the high end of its full-year earnings forecast. Previously, they were talking about $7 to $9 earnings per share. Now they say it'll be $7 to $8. Although, given that Wall Street was only looking for $7.24 entering yesterday, it's not a total surprise. Now, here's what is. Where's the weakness coming from? Target said that its food and beverage and hard lines categories delivered comparable sales growth in the quarter, but that was offset by, I'm quoting here, continued softness across the broader discretionary portfolio, end quote. That's what I used to love about Target. It used to be great. Plus, Target's traffic was down 2.2%. Their customers are spending less with each visit, as their average transaction amount declined by 0.5%. Now, Target's got a new CEO waiting in the wings, with current Chief Operating Officer Michael Fidelki taking the reins in February. He's already talked about the need to improve the merchandise assortment, provide a more consistent shopping experience, use technology to breathe some life into the business. But based on what we saw from Target yesterday, well, let's just say he's got his work cut out for him. Finally, we got this really strong quarter from TJX. That's the parent company of TJ Maxx, Marshalls, Home Goods, and a couple of other brands. And it's another name we own for the Charitable Trust. This one's very different from the other retailers that reported this week because TJX is the leading off-price chain. They're playing a different game than regular retailers. When other retailers get stuck with excess inventory, they typically unload it to companies like TJX for a fraction of what it's worth. Because the need to get rid of the old stuff before they can bring in new merchandise is an imperative. That means this company thrives when the rest of retail's in trouble. One reason why TJX is up more than 20% for the year, while these other three companies are all in the red. Sure enough, this time TJX reported a clean top and bottom line beat, 5% same-store sales growth, when the analysts were only looking for 3 to 0.7%. That's a nice beat. 3.7 goes to 5. While TJX issued slightly weaker than expected guidance for earnings and same-store sales in the current quarter, that's par for the course, people. This company is one of the top practitioners of UPOD, and that's initials for under promise and over-deliver. Other than semi-cautious guidance, there was almost nothing to take issue with. All four of TJX's operating segments, Marmaxx, Home Goods, TJX Canada, TJX International, outperformed. In a complete contrast to Target, the company saw improvement in both the number of transactions and the average transaction amount. And TJX's management seemed almost giddy about the opportunity in front of them, with CEO Ernie Herrmann, who is so good and unheralded, saying that, quote, availability of quality branded merchandise has been exceptional, end quote. Again, when the rest of retail's in trouble, TJX makes out like a bandit. The one thing about TJX is that its stock tends to either sell off or do nothing after the company reports, even when the numbers are good. We actually raised our price target on this one for the Charitable Trust yesterday, even as the stock finished the day up less than 0.2%. It rallied another 1.6% today, despite the terrible tape. I still think it's a steal. So looking at the four big retailers that reported over this week, there's plenty to worry about, even as some of them are doing just fine. Home Depot had a weak quarter. It desperately needs lower interest rates. Lowe's did better, but it's not on fire. Target stunk. TJX was excellent, but TJX is not a normal retailer. Here's the bottom line. With all the hand-wringing about the state of the consumer, this was not looking like a great week for retail until this morning when Walmart shut the lights out. I mean, it was beautiful. More on that one after the break. For now, just know that you got to be selective when you're picking retail stocks in this environment. Not a lot of them are working. Mad Money's back after the break.
Coming up, Walmart earnings are in, and they could offer the clearest read on how the American consumer is faring. Cramer's digging into the winners, the worries, and what's next when Mad Money continues.
Before the break, I walked you through the mixed bag of retailers that reported earlier this week. But today we got something, look, it was just purely positive, and it was Walmart. This stock was already one of the best performers of the group, but its valuation got a little stretched, trading around 40 times earnings. And longtime CEO Doug McMillon plans to retire and pass the baton to the head of Walmart U.S. in February. Turns out there was nothing to worry about at all. When Walmart reported this morning, it blew away the numbers, posting a 2-cent earnings beat off a 60-cent basis with much higher than expected revenue. And Walmart U.S. same-store sales, excluding fuel, up 4.5%. Wall Street was only looking for 4%. These numbers were driven by 1.8% transaction growth and an average ticket increase of 2.7%. Basically, more traffic and more spending per customer. Fantastic. At the same time, Walmart saw a big pickup in its digital business. Global e-commerce sales up a staggering 27%. A couple of their ancillary businesses are starting to become big contributors, too. Walmart's global advertising business up 53%. Membership income up 16.7%. Again, amazing. And out of nowhere, you would have thought it'd be alchemy if you didn't know it was real. While Walmart's margins were basically flat, they still put up 35% earnings growth, well above expectations, even if that included some one-time positives. When you back these out, you still get nearly 7% earnings growth year over year. Best of all, for the second straight quarter, Walmart raised its full-year forecast for both net sales and adjusted earnings. Management's new outlook calls for 4.8 to 5.1% net sales growth, when the street was looking for just 4.2%. Their operating income is now expected to grow by 4.8% to 5.5%, when the analysts only expected 3.9%. Phew. And the new earnings outlook for the year is $2.58 to $2.63 per share, which is basically in line with the analyst consensus, but it still represents a nice boost. On the conference call, management gave a proud overview of widespread strength across their entire business. Here in the U.S., Walmart told us that it's taking market share both in grocery and in general merchandise, with outgoing CEO Doug McMillon saying he's particularly excited about what the company's seeing in its fashion categories. But e-commerce was the key positive swing factor for the quarter, and while the 27% revenue growth for e-commerce was incredible, management also said that Walmart's benefiting from business mix changes and lower international losses in e-commerce, making the entire digital operation more profitable. It's just good after good. Speaking of international, that business is on fire. It had the best growth of any of Walmart's three major segments, with sales up 10.8% or 11.4% on a constant currency basis. McMillan gave us a quick walk around the world with great things to say about most of the company's international markets. In China, Walmart's rapidly building its e-commerce infrastructure and improving service. 80% of digital orders in China now arrive in under an hour. Don't you want that? In India, the company's Flipkart business is performing well, executing a record, quote, big billion days, end quote, event in the quarter. That's the Indian equivalent of Amazon Prime Day here, or Alibaba's Singles Day in China. Made-up shopping holidays created by big online retailers, always a sign that capitalism is alive and rapacious as ever. Meanwhile, Walmart's Mexican business was a growth driver, and McMillan seemed to be excited about the opportunity the company has in Canada, too. The worst part of Walmart's quarter, if you want to call it that, was Sam's Club. But even that business had numbers that most retailers would kill for. Sam's Club's U.S. comparable sales, for example, came in at 3.8%. All right, that's a bit below 4.9% the analysts wanted to see. But if Target put up that kind of number, they'd be dancing in the streets of Minneapolis. Sam's Club is also doing great online, 22% e-commerce growth in the quarter. Remember, Sam's Club is like Costco. You pay a membership fee, and then you get to buy in bulk. Management said that they're seeing healthy membership growth, strong renewal rates, and more business from Walmart Plus members. Walmart Plus doesn't get you a Sam's Club membership card, but it does get you discounts at the gas station side of the business. Now, management also had some interesting things to say about the state of the consumer on the conference call. And unlike many others, these guys were very specific. I've been saying for a long time that Walmart keeps winning because they've been able to attract more and more high-income customers. And like me, like my kids, still doing it. As for middle and lower-income consumers, it's more complicated. McMillan described middle-income households as steady, but he also said that lower-income shoppers have, quote, been under additional pressure as of late. He's understated, telling the truth. Given that lower-income customers have long been Walmart's bread and butter, the company's making a concerted effort to offer better prices for necessities to keep people coming back. And believe me, everybody loves a bargain. McMillan noted that Walmart's U.S. like-for-like inflation was 1.3%, with food and general merchandise up low single digits. He didn't say this explicitly, but just reading between the lines, that probably goes a long way toward explaining why the company's still taking share in multiple categories. Consumers are fed up with years of persistent inflation. They desperately want value, and Walmart is giving it to them. I've said it before. I'll say it again. Walmart's doing more to fight inflation than anyone at any level of our government. Finally, during the conference call's question and answer session, CFO John David Rainey was asked about how the consumer is doing entering the fourth quarter, and he gave a cautiously optimistic answer. Here's how he put it. Quote, holiday is off to a pretty good start. Back to school tends to be an early indicator for how that goes. Halloween, likewise, for Thanksgiving. And everything that we've seen so far makes us optimistic and encouraged about customers and members leaning into the seasonal events and holiday shopping period, end quote. Sounds good to me, or as good as he'll ever state it. When you put it all together, it's no wonder the world's largest retailer saw its stock surge more than 6% today, although it was actually down at one point in the early morning, making it the best performer in the S&P 500. Every part of the business, U.S., international, Sam's Club, performing well. E-commerce continues to grow like a weed. And Walmart's somehow finding ways to both bring in more high-income consumers and take care of the lower-income shoppers to boot. Thoughtful. Oh, and a surprising development, Walmart, after thorough discussion with the board that Doug McMillon initiated, is moving over to the NASDAQ. Here's the bottom line. Walmart stock still looks expensive on an earnings basis, but on days like today, you can see why so many investors are willing to pay up for it. At the end of the day, investors are willing to pay a premium for quality, and Walmart's among the best in the business. This is one you have to hope will come down in a broader market sell-off. I don't know if there's any other way to get it at a discount. Let's take some calls. Let's go to Bill in Massachusetts. Bill.
Jim, your new book is phenomenal. Your staff's incredible. I listen, I diversified. Is it too late for me to get into Procter & Gamble?
No, it's not. We just initiated the position for the trust. Why? Because it sells at 21 times earnings, got about a 3% yield. That's about as low as you ever get Procter, which, of course, is a dividend aristocrat. I think is a fine level. And thank you so much for the kind comments about the book. It's selling real well. I'm very proud doing a lot of these, doing TV stuff to help getting the word around. But you know what's better than that? Having Bill from Massachusetts say he likes the book. Thank you, Bill. Walmart is firing on all cylinders, and even though the stock is still expensive, it's easy to see why people are willing to pay up for it, especially on a day like today. Much more Mad Money ahead, including my post-earnings exclusive with Gap. I'm running through the retailers report with the CEO. Then we're getting some amazing opportunities to buy stocks at terrific prices because of an endless flood of acquisitions. I'm revealing the names I'm watching. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. Typically, when companies merge, the stock of the acquirer tends to come down. Ever since the White House changed hands, we've seen an endless spate of acquisitions. That might make your eyes glaze over, not mine. These deals are creating some incredible bargains for us. For example, this morning, Abbott Labs announced that it's buying Exact Sciences, that's the colorectal cancer screening company, for about $21 billion. It's a 51% premium where it was trading before we started hearing talk of the deal. This transaction will be the largest healthcare deal in 2 years and the largest diagnostic acquisition ever. Exact Sciences has a great product. Their Color Guard, their platform, it's COLO Guard. You've probably seen the ads sometimes in football, is a quick and convenient at-home stool test for colon cancer, which is the second leading cause of death of all cancers, not because it's particularly dangerous, but because people don't get tested. They know that a colonoscopy is a pain in the posterior. Exact Sciences gives you a much less invasive way to test for colon cancer. They've sold 20 million of these Color Guard tests since it was approved, but in 2014, it's covered by insurance and Medicare too. So having to slot it right into their diagnostic portfolio. Of course, this kind of deal probably would have been blocked by Biden's antitrust regulators, if only because the FTC under Lina Khan seemed reflexively hostile to all mergers. But under Trump, it'll probably sail through. Now, normally an acquirer stock only gets hit hard if they're paying for the target with their own shares. But Abbott's paying in cash, and it's still dropped more than $6 over the past 2 days since the deal was reported. I think that's crazy. Abbott has a big hold in its diagnostics business, and Exact Sciences would plug it. The rest of the business is doing quite well, so I think it's a terrific time to do some buying, especially as once in the portfolio, it will accelerate Abbott's growth rate. All right, this is one we've talked about a bunch. Kimberly-Clark's bold, nearly $49 billion bid to buy Kenvue, which is the J&J's old over-the-counter business that makes Tylenol, Band-Aids, Aveeno, and so many other household names. I think it's incredibly compelling, as Kenvue stock is really near cut in half from where it came public. Of course, there are risks. The Secretary of Health and Human Services has blamed Tylenol for causing autism, but he seems to think kind of everything causes autism. At the same time, Kenvue is still being sued overseas for its talc exposure, the same kind of lawsuit that weighed down J&J for years here in America. But our country has a uniquely lottery-like legal system. In the rest of the world, no. You just can't sue for near infinite damages like you could here. They standardize these things. No jackpot justice overseas. To me, that means it's time to buy the stock of Kimberly-Clark. Worst case, another acquirer comes in, at which point Kimberly-Clark goes right back up. You'd be getting a premier consumer packaged goods company for 14 times earnings with a almost 5% yield. I like that. And I still like Capital One COF for its acquisition of Discover, a credit card company that gives them the edge at the register, because it's cheaper for merchants to use Capital One Discover than Visa or MasterCard. The stock sells at 10 times earnings, even as the company has about 160 million cards in circulation. Block, the old Square that we talked to last night, it has around 57 million Cash App users, and it sells for about 25 times earnings. That doesn't make sense to me. Sure, Block has a younger client base, but Capital One Discover has got really fabulous scale. Listen, we haven't had many mergers in the past 4 years. People forget how bountiful they can be, especially if the stock of the buyer gets knocked down. Look for this trend to take off. If history's any guide, it can make us a lot of money. And money's back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
Before we get started with the lightning round, listen up. Black Friday came early. This is a special deal to join the CNBC Investing Club right now. You'll get my top market calls and every move inside the Travel Trust. Scan the QR code or head to cnbc.com/Cramer Club. And now it is time for the lightning round. Let me say my stocks are by myself, so there's no calls at that time. My step is my step. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's go to Ryan, Ohio. Ryan.
Booyah, Jimbo.
Booyah.
What do you think about rocket companies, RKT?
I got enough problems. I don't need no rocket companies. I can't get. No one's buying homes here. Let's go to Kathy in California. Kathy.
Well, yeah, Professor Cramer. This is Kathy from Walnut Creek, California. I've been watching your show just fine. Watching your show for 20 years. I'm an active club member. My question is on Regeneron.
I should have been recommending Regeneron. That Len Schleifer pulled the rabbit out of a hat. Is coming right back right now. By the way, I'll give you a twofer. So is Amgen. Let's go to Sean in California. Sean.
Hey, Jim. A wise man once said, Eric Grubman is money. So on a day like today, I'm adding to Supergroup. I'd like to know what you think about that.
Well, Supergroup, Eric Grubman, his money. He's been a friend of mine for I don't know how many years, and he came on the show. And that when they launched that company, and I guess what you got more than a double. It's fantastic. I like it still. Let's go to Matt in Texas. Matt.
Hello, Mr. Cramer. Wonderful to speak to you.
Oh, same. What's happening?
I want to ask you about Fubo. I wonder if it's too speculative.
Fubo. I don't know. Let's do Netflix instead of Fubo. I like Netflix more. Just saying. Let's go to Sam in Pennsylvania. Sam.
Jim, how are you?
I'm doing good. How about you, Sam?
Good. So I stumbled upon this small cap stock based out of Reading, Pennsylvania. They're engaged in energy storage for industrial and military use. It's only a $5 billion market cap. They've seen sales growth roughly 8 to 10%, but the earnings acceleration in this company is what got me excited. So I'm curious what you think about Enersys here at $132.
I don't know Enersys, and I should, given the fact that I was born not that far from where they are. Let me come back. I'm going to sit down with Ben Stoto. We're going to hash this one out and really get to the bottom of why the stock is doing so well and whether that can continue to happen. Let's go to Mary in Utah. Mary.
Hi. Thank you for taking my call.
You're quite welcome, Mary. What's going on?
I want to know what the best strategy is for long-term investment.
Best what? You have a stock there, Mary?
What the best strategies are for long-term investments?
I'm not sure. I don't know the stock that you're asking about. Do you have an individual stock, Mary?
Yes, Flutter stock.
Flutter. There is an incredible war to open accounts, I guess, right now because oh my God, Flutter keeps going down, and it's a really good company. Got to wait till that war ends, I think. And that led to the conclusion of the lightning round.
The lightning round is sponsored by Charles Schwab. Coming up, Gap delivered a quarter with real style. But is the stock the right fit for your portfolio? Cramer sits down with the CEO, fresh off its report. Next.
This tough environment for retail, as I mentioned earlier, but great merchants won't let that stop them from putting up phenomenal numbers. Take Gap Inc., which has been taking some time to turn itself around under CEO Richard Dixon. After the close, though, Gap reported a great quarter. This was a 3-cent earnings beat off a 59-cent basis with a higher-than-expected revenue, 5% same-store sales growth, and it's only looking for 3.1%. Same time, management raised their full-year forecast for both revenue growth and operating margin, and that's why the stock's flying in after-hours trading. So can it keep running as we head into the all-important holiday season? Let's check in with Richard Dixon, the president and CEO of Gap, to find out. Mr. Dixon, welcome back to Bad Money.
Jim, thank you. It's good to be back with you.
Okay, so Richard, these were across the board unbelievable numbers. I've got to tell you, I want to start with Old Navy. It's gigantic, a fantastic 6% comp. I've been waiting for something like that, but I never thought that it could happen this quickly. What's going on?
Jim, our strategies are working. It's working across the board. It's clear. We're showing momentum. And it's not just Old Navy, although I want to talk about it. Old Navy up 6, Gap up 7, Banana up 4, gross margin exceeding expectations. I mean, we really are starting to see the flywheel come about. Old Navy had an incredible quarter. Comps up 6%, with the brand consistently delivering market share gains. And that's over the last 2 years. So this isn't just a one-off. Old Navy is the #1 specialty apparel brand in the U.S. And this performance really speaks to the brand's strength, consistency, and the continued momentum. I would tell you, Jim, customers are responding to what Old Navy does best. Great style at great value. We saw growth across all income cohorts. Our AUR was driven by trend-right product. And of course, it's all being amplified by better, compelling, creative, and storytelling. So we're incredibly proud of the team at Old Navy, and I really do believe that brand is just getting started.
Now, you have been very good at, let's say, selecting celebrities to be able to feature, and they're surprising, which I absolutely love. How is that working?
Collaborations are important as they drive relevance that ultimately can drive revenue. And I would call out Old Navy again. I mean, we saw a great response to our partnerships with Disney, for instance, Jingle Jammies, exceeding expectations, and our recent partnership with Anna Sui, which, as an American fashion legend, I mean, this was a collaboration that was particularly meaningful, as it was the first designer collaboration bringing really high fashion to a broader audience. And you know, we've done that with Gap. I mean, I think we're on our 13th consecutive partnership and collaboration. We just finished one with Sandy Liang, which did incredibly well. The Gap partnerships have really driven attraction to Gen Z. And of course, you know, the global fantastic execution we did with Cat's Eye, which generated incredible impressions, over 8 billion impressions, 500 million views. It was a cultural takeover. We're so proud of the team's execution in these collaborations.
Let's talk about Cat's Eye. This was something that you were able to realize, that the impressions would translate to sales. I see a lot of people get impressions and they don't translate to sales. What is getting it so they see and then they buy?
Well, we talk a lot about relevance and revenue. Relevance can be had, but if you don't have the product when the traffic gets there, and you don't execute with excellence in your stores and online, then it's just relevance, which ultimately doesn't necessarily show up on the scoreboard. So when it really works is when you drive relevance that drives revenue. And again, each campaign that we've done, and you know we've done several, has gotten better and better and better. And the culmination of those has been the Cat's Eye campaign. I mean, it has been the brand's most successful campaign to date. It's generated significant traffic. It drove double-digit growth in denim. The denim ranking for Gap, we were number 8 last year. We're now the number 6 adult denim brand in the U.S. Growth in AUR, growth in consideration, organic impressions, new customers. Again, Gen Z is discovering us, but it's important to note while we're reinforcing loyalty with our core customers. So this is really an ongoing flywheel that the group is getting stronger and stronger, and customers are getting more and more excited with our work.
Last quarter, Banana Republic was a little off. You told me not to worry, that it was just, it was temporary. It looks like that was a great call again. Banana Republic snapped right back.
Banana Republic is, again, delivering exactly what it said it was going to do. I mean, this is a clear sign that the brand's reinvigoration is making steady progress. I'm really proud. The team has done a great job leaning into the brand's heritage. We've talked a lot about the brand's heritage, and it's strengthening our position as a modern explorer brand. You know, we've had great, consistent business in the men's business,
yes,
and we've had a lot of work to do on women's, but we're starting to see really good harmony between men's and women's. We have a lot of progress that we've made, but we've got a lot more work to do. Stay tuned.
Now, I am actually intrigued by the hit to Athleta. I don't think you can turn it without finally ripping the Band-Aid off. This minus 11 number may actually be a sign of change.
Look, we are disappointed in the trend for Athleta, but I will tell you, Maggie, our brand president, has hit the ground running. It is her first 90 days. She's balancing what we all know, near-term priorities, but with longer-term reinvigoration plans. As I've said, she's building her leadership team to align her vision, setting the foundation for the brand's next chapter. There's a lot of work that we're doing. We're editing the assortment. We're studying the consumer. We're evaluating our retail footprint and the overall customer experience. And we're following our playbook. This will be a reset year for Athleta. Our focus is on positioning the brand for the long-term success and returning it to its rightful place as a premium, purpose-driven, aspirational brand. I believe Maggie and the team are doing the right work. It's going to take some time, but I am confident that Athleta will reemerge as a brand that really does matter more to women and matters more in our portfolio.
So, Richard, how does it work that our conversation last time had to be dominated by tariffs, and it's just an afterthought now? How did it evolve like that?
I will tell you, it's more than an afterthought. I mean, we manage and deal with tariffs and what we can control every day. Our team has done a great job with our mitigation plans. We've been focused on thoughtful adjustments to sourcing, manufacturing, our assortments, and many other actions that take place here every day. The third quarter tariff impact was about 190 basis points, but it was in line with our expectations. And despite this, we exceeded our gross margin outlook, which was driven by brand momentum. And that's what's most important. Customers are resonating with our product. It's leading to less discounting, better regular price sell-through. And again, as we pursue our mitigation plans, most importantly, we remain focused on sustaining the momentum and market share gains that our playbook is driving. So tariffs are here, but we're managing them really well. And again, we're excited about finishing the year strong.
Well, that brings me to the last thing I want to talk about. I am now hearing, because I think you have a lot of new customers and you're taking them from other places. I was with someone the other night who said, look, I don't have to, I've got everything bought for Christmas because I had the points. I went to Gap. I'm done. I mean, now I never thought about talking about the reward system with you.
It's true. Look, first of all, what I really am proud of is we're seeing consistency and strength in our customer behavior, and we're seeing it across the board. We had equal growth in all income cohorts, top, middle, and bottom. And again, evidenced by our two largest brands, Old Navy and Gap. We all know that there's pressure and particular pressure on the lower income consumer, but our customers are finding our price value and style, and it is breaking through the competitive landscape. Less discounting, better regular price sell-through, increased AUR. Our product is resonating, and when you concentrate on executing with excellence with great product, great merchandising, great marketing, and great service, you can win in any market.
All right, Richard, we're going to leave it there. Congratulations. Just a monster good quarter. Richard Dixon, President and CEO of Gap. Thanks for coming on.
Thank you, Jim, as always.
Absolutely. I'd like to say there's always a bull market somewhere. I promise it's just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
Booyah for the Emperor of Cramerica.
Honorable James J. Cramer.
You got me jumping around my office right now.
Thank you so much for all you do for us.
I enjoy your show, and I find it very entertaining and informative.
I watched your first ever episode of Mad Money back in 2005, and I've been watching every single episode ever since.
Don't miss Mad Money every night at 6 p.m. Eastern. Plus, join the CNBC Investing Club and stick with Cramer around the clock.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.